Okay, turning to the statement of cash flow. Here you can see the definition. The statement of cash flow, we simply mean the difference between the numbers of dollars coming in to the company and the numbers of dollars going out of the company.
A cash flow statement records the amounts of cash and cash equivalents entering and leaving the company. Cash flow statements reveal a company's financial health. Companies use them for budgeting because they predict future cash flow. Cash flow is determined by looking at three components. The core operation component reflects how much cash comes from a company's products or services. Changes in cash, accounts receivable, depreciation, inventory, and accounts payable are reflected in the cash from operations. To calculate cash flow, adjust the net income by adding or subtracting differences in revenue, expenses, and credit transactions. Non-cash items calculate into the net income as well as assets and liabilities. Transactions not involving cash items often have to be reevaluated when calculating cash flow from operations. For example, depreciation is not a cash expense. It's an amount deducted from the total value of an asset, like manufacturing equipment. It's added back into net sales when calculating cash flow. Income from an asset is accounted for in cash flow calculations only when it's sold. It's considered cash in. Changes in equipment, assets, or investments relate to the investing component. Investing is considered cash out because cash is used to buy, for example, new equipment. Changes in debt, loans, or dividends account for the financing component. Financing is cash in when capital is raised, and cash out when dividends are paid.
Okay, measuring the cash flow in outflows caused by core business operations. The operations components of cash flow reflects how much cash is generated from a company's products or services. Generally, changes made in cash, accounts receivables, depreciation, inventory, and accounts payables are reflected in cash from operations. Cash flow is calculated by making certain adjustments to net income by adding or subtracting difference in revenues, expenses, and credit transactions. Now turning back to Home Depot, there were three sections with the cash flow, and this one we're looking at operations. Of course, you can see that the net income here, which you can find this amount in the income statement, is $6,345. Of course, that's in millions. You can see depreciation here. Depreciation is not really a cash revenue. It is an amount that is deducted from the total value of an asset that has previously been accounted for. That is why it is added back into net sales for calculating cash flow. The only time income from an asset is accounted for in the cash flow statement calculation is when the asset is sold. Now let's look at accounts receivables, which is a negative 86. Accounts receivables on the balance sheet from one accounting period to the next must also be reflected in the cash flow. If accounts receivables decrease, this implies that more cash has entered the company from customers paying off their credit. The amount by which the accounts receivable has decreased is added to the net sales. If accounts receivables increase from one account period to the next, the amount of the increase must be deducted from the net sales because although the amounts represent in the accounts receivables or revenues, they are not cash. Okay, let's look at inventories. As you can see, this is a negative 22, which of course is in millions. An increase in inventory, on the other hand, signals that the company has spent more money to purchase more raw materials. If the inventory was paid with cash, the increase in the value of inventories is deducted from net sales. A decrease in inventories would be added to net sales if inventories was purchased on credit, as an increase in accounts payables would occur on the balance sheet. And the amount of the increase from one year to the other would be added to the net sales. As you can see here coming down, this is what you're looking for. When we talk about trends or patterns, they have a positive cash flow from operations, which you want to see. Now, sometimes you can have some negative ones, but if you're looking for positive and you're looking for them to increase, you can see 8,127. Of course, that's in millions. Okay, let's continue with the other two areas that we're going to look at. The first one here is cash flow from investments, and we'll end with the cash provided by financial activities. Okay, looking at the investments here side, Changes in equipment, assets, or investments relate to cash from investing. Usually cash charges from investing are a cash out item because cash is used to buy new equipment, buildings, or short-term assets such as marketable securities. However, when a company de-invests of an asset, the transaction is considered cash in for calculating cash from investing. And as you can see here, we have a negative, so they must be doing some capital investment here of a negative 1,258. Now you remember that's in millions. Okay, now let's turn to the last part here, financial activities. When we're talking about cash flow statements here, changes in debt, loans, or dividends are accounted for in the cash from financing. Changes in cash from financing are cash in when capital is raised, and they are cash out when dividends are paid. Thus, if a company issues a bond to the public, the company receives cash financing. However, when interest is paid to borrowers, the company is reducing its cash. And you can see again we have a negative number here of 206, and again that's in millions. Okay, continuing on to remember on the last page here we talked about let's see here the negative 206 in millions here. That's taking both of these numbers here, the negative 1,258 millions, and then the negative 7,075 in millions, and that's where you come up with the 206 negative figure here. And like I said, how we figure that out is taking the positive from operations of 8,127 and then adding up the two negatives, and of course we have a negative here. Of course you're not going to want to see a lot of negative when we're looking at a company, but sometimes you need a negative number, especially when you're plowing money back into a company, especially buying capital into projects and buildings and things like that. They do have a positive from operations, and eventually you'll see a positive number down here, which is what you're looking for in the long run.